tonight. And today we're going to go wherever you guys want to go with the chat. But I'm going to start with a little preamble that I always do. Well, YouTube does its thing and sends the notification to everyone. It says, hey, Mike's live. I titled today's video, I just kind of made this up. I was like, what am I going to title it today? And my topic of today, I guess, when I woke up was more money, more problems. And what I mean by that is partly it's more opportunity. Everywhere I look, I see opportunities. There's so many different businesses I can chase in so many different sectors. There are so many people wanting to partner or, looking for the next big idea. And I find that with so many opportunities, the type of person that I am, I'm an analyzer. So I'm a, what's the word? Like, I'm up here in my head all the time. I can't not find the optimum solution. So I'll be laying in bed at night analyzing 3 different scenarios. Even when I'm, for instance, like doing my calls and puts on my options stuff, my brain is working hard on that problem. Or as an example, last night, I sold my house, this house here, closing later this summer. And you guys already know I bought my new house. I sold it off market. And, I've been finding that it's really, really a challenge for me to turn my brain off. And the more that I've, sort of progressed on my FIRE journey, the more I've found that there's more stress with all of the different businesses that I'm involved in and all of the different, I don't know, I feel like just the more you have to deal with and the more analyzing that you need to do, the more stressed out you can become. So I'm just going to share with the world here. I thought that life gets easier as you build wealth, but what you find is that it's tough to diversify everything. And in the pursuit of chasing the things that you enjoy, you often oversubscribe, and people with lots of money have lots of different businesses and different business interests, and that divides your time. And too divided can make you feel stressed. And so there's not necessarily, I know a lot of people watching this are probably thinking like, if I can just get to FIRE, if I can get to that financial independence, retire early stage, I'll be good to go. That's the goal. But I think, there's a lot to analyze with how do you build that perfect life and what does that entail? I don't know if the chat's even on. If can someone jump in the chat and tell me if the chat is even on? I may not have, I may have accidentally turned the chat off if I said it was for kids or not. I think it just says no, it's not for kids. Someone, if the chat is working, someone pop in the chat. If it's not working, I'll have to reload the stream. But okay, cool, it is working. Okay, good, thank you. I see it, hey, testing chat, perfect. Okay, cool. It also says 0 people in the room for some reason. I don't know why it's saying that, but my screen might just be messed up a little bit. So obviously I'm seeing people in the chat, so I know that people are here. YouTube's just messed up. Yeah, so I guess if you guys have any questions, throw them in down here. I'm thinking that given I don't have a topic, you guys will fuel this conversation. While I wait for, if you have any questions or things you want to ask on tonight's stream, I'll talk about what I've been up to in the last week. So one, I sold my house, conditional until Friday, so we'll see if it firms up. I sold it off market. I didn't put it on the MLS. A lot of people are going to jump in here and be like, Mike, you could have got max value on the MLS. Like, you tell everyone to list. But there's a lot that goes on behind the scenes, I think, that I would have had to do. And I would have had to get, everything in my house perfect. I would have had to, go through all the listing paperwork. And then I would have had to deal with showings for like 10 days of like back-to-back showings during COVID. And I had to basically leave for a week. And every time you go on MLS, there's a gamble. You don't know how your house is going to do. And so I took an off-market, I kind of took an off-market approach, and I had an agent that had an interested buyer. Without competing, they put an offer in at basically what I was asking for. Now, I think I asked probably too little, but when I can release the data, I will. I'll share with you guys how I did. I did very well on the house. We made lots of money. The market's appreciated a ton, so I've rode that appreciation curve up, which is fantastic. But I also think, or sorry, what I've noticed is in certain price points in London, there's a weakening or a softening right now. And I don't know if it's temporary, it probably is temporary, but right now there are opportunities. There are properties selling for less than ask right here in London, Ontario, not in multiple offer situations. People have this stigma in their brain that every property is priced $100,000 under market. So they just add $100,000 to the price tag. And in some cases, the houses are being priced at what they're worth. And so everyone just assumes it'll go 100 over, so no one offers. You can jump in there and get a deal. And I've been seeing a few of those opportunities pop up. If you're bullish on real estate, in the next year or two, that would be, great that you're getting the property at a little bit of a discount. Now, if you believe the market's going to correct, then still staying on the sidelines might be smart. I think a lot of people are waiting and seeing. I think lockdown has basically removed all of the pressure from the Toronto buyers are coming into London, the Toronto agents are coming into London. We're not seeing that right now. There's just, because of the lockdown, there isn't that essential need to travel to London to look at rental properties. And so that's cooled things a bit. Having just the local people in London, and we're supposed to not be looking at rental properties. We're supposed to be just doing essential real estate transactions, right, in the lockdown. We're not supposed to be shopping for an investment property. We're supposed to be, buying a house if we need to, or selling our house if we have to. But I don't know, it's sort of, I think the sentiment right now is to not be out shopping, and the cool weather hasn't helped here in London. That never does well for real estate. You want nice, warm, sunny weather. The landscaping to be all perfect. And I think that, there's opportunities. If you look in the right places, there are opportunities right now. That said, we just went through a 45% appreciation. So if you're looking at prices now versus last year, good luck. Everything's 50% more expensive, but it is cheaper than it was a month ago. I think not that it's cheaper, there are more opportunities right now where you don't have to compete, therefore allowing you to score a better deal or get better terms on the property that you're buying. So that's an opportunity, I think, in London. But yeah, that's kind of what I'm seeing in London, Ontario right now. I'm still looking to dispose of a few more of my properties in my portfolio. I may acquire something else in its place. If Canada had 1031 exchange, it'd be perfect. But unfortunately, the Rosehart, the Rosehart portfolio analysis tool that I use, like a little spreadsheet, it's telling me that I need to sell off a few properties. It's saying, hey, given current rents and current value of that property, it's maxed out. There's not much more potential. You should sell that asset and get a higher return on equity. So yeah, I'm going to do that. I follow a strict, like quantitative approach to real estate investing. Of course, I bring the soft stuff in, but it comes down to the numbers at the end of the day. And I'm in real estate to make money. I don't do it because I love it. I don't do it because I like talking to, well, I don't really talk to tenants, but I don't do it because I like to talk to a property manager or because I want to, deal with contractors. No, it's work and it needs to generate enough return to be worthwhile. Otherwise, I'll lever up and buy REITs. I think that leverage-wise, you could buy REITs right now, and you could use, for instance, Interactive Brokers would allow you to do, 3.34 to 1 on most REITs. So it's like, let's say even 2 to 1, right? Or let's say 3 to 1, that's pretty far levered, but let's say 3 to 1. REITs are already levered 2 to 1 or 3 to 1. So you could essentially put 5 or 10% down and control a large portfolio of real estate or a micro ownership in a large portfolio of Canadian real estate if you're bullish on residential, or you could pick a commercial REIT if you like commercial stuff. But I'm like, at scale, in theory, they can buy and hold better than I can. Can they buy smarter than I can? No. The REITs definitely are not getting good deals at scale. You can't do it. You can't arbitrage the market at scale. It just doesn't work that way. You can't find 2,000 wholesale properties a year, right? Or millions and millions in real estate. You just can't do it here in my market. So definitely I would say if you're gonna buy, I probably will still flip, and you guys know I've been doing some flips. I shared on my Instagram, I have Rosehart recent flip that we're just finishing up in Sarnia. We've got 3 on the go now there, or shortly we will after they close. So I'm still actively acquiring stuff that's under market value. That makes sense. If I can see a deal where I'm like, hey, it's 50% of ARV or after renovated value, I'll buy that. That's an undervalued asset. Now, after it's been brought up to realized value, I increase the value in it through renovation or whatever I have to do. Most times it's renovation. But I realize the optimal and best use for the property and the highest and best use, therefore maxes it out and it's worth X. At that new valuation, the cap rate's not very good because now I've unlocked most of the value in the property. And so for me, that means, I think a big piece of it is realizing where there's big value. And in real estate, there's big value in the arbitrage. The holding of real estate, forget appreciation, right? Because you can buy a REIT and enjoy market appreciation. You don't need to own property yourself to enjoy appreciation. So forget appreciation and forget leverage, because you can lever up a REIT using interactive brokers. You could go 5 to 1, 20% down, exact same thing. Buying REITs that are already levered, and then you lever to buy the REIT shares. So leverage wise, you can accomplish the same thing. But what you can't do in the public market is buy properties for 70 cents on the dollar and then realize that gain, right? That's where, like, on the buy and the transformation, that first, I would say in the first 6 months that I own a property, my ROI is always triple digit. I've never not had, so far to date, every single real estate deal I've ever done has had a triple digit on the a triple digit ROI, which means 100% or more on my down payment. That's been every single deal I've ever done. Let's say within the first year and a half max. By the time I got tenants out, or I'm just thinking the property took longer to transform because the tenants fought me. But like, let's say 2 years max, you get a triple digit return. You can't do that with the REIT. But what you could do with the REIT is, if the market appreciates 10%, you could lever up and you could be 5 to 1 on the REIT, right? The REIT's already levered a bit. So it could do, if the market does 10% appreciation, the REIT will probably do 20%. And then if you bought those shares, 3 to 1, then you'd be getting 60% return because you're levered again on those shares. You've bought more shares than money you had, borrowing from interactive brokers at prime minus 1%. So that's like, when I compare that strategy to the buy and hold, the buy and hold doesn't make sense. Buy and hold takes time, effort, energy, stress. You got to pay the bills, you got to manage the bills, you got to renew the mortgages, you got to qualify for the mortgages, you got to fight with the property managers. You may have to fight with the tenants, the contractors, and maintain the property and everything else. And then all the risk of fire and flood and tenant destruction and vacancy and bad debt expense when they don't pay, and landlord tenant board, and all this negative climate, when you could just buy a REIT and they're operating at scale, do a better job than you can do, getting, maybe slightly less cap rate. But when you adjust for all those other things I just mentioned, I don't think buy and hold makes a lot of sense. There's a reason I still buy and hold. The reason is it's a lot of work for me to sell my entire real estate portfolio off. That's one reason. Two is the tax. There's a big tax liability. If I sell my real estate portfolio, I'm probably looking at, if I sold my entire real estate portfolio, I'm looking at a 7-figure tax bill. And I can refinance and pull all my capital out tax-free, right? So I'm more inclined to want to refinance, keep the property, and then basically the only equity in the property is the tax liability that I would have had to pay if I sold the property. So that's a lot of what's been holding me in real estate on the buy and hold side, if I'm being honest. I like to acquire real estate. It's just, once it's realized its value, there is no good numbers argument for keeping the property. I think you could buy a REIT that can do the exact same thing, and you could, like, there are REITs that buy, I don't know, you could probably look some up, I don't know, in the Midwest US, where cap rates are 10 to 15, I guarantee you there's a REIT out there that's able to get a 20% return on capital for their investors. I guarantee someone out there is doing it at scale. And you can just buy into that, right? Instead of buying and holding and getting your 20%. Like, most people, when they buy and hold, after they look at the realized, new cap rate, not the cost base, because you can't look at the cost base. Once you've unlocked the new value, that's what you have to run the numbers at. So if you bought a property, as an example, if you bought a property for 200 grand and the property is, worth 400 now, because you put 50,000 renovations, a little bit of appreciation, whatever, you bought into market, when you buy it for 200, it's worth 300, let's say, whatever. That's a very common scenario. I used to do a lot of those kind of deals. And, at 400,000, the rent's, say, $2,500 a month. Like, actually, that's pretty good in London. I would say a $400,000 property is probably rented for a little over $2,000 a month this day and age, right now in the London market. So you bought this property for 200, you put 50,000 in it. It's a great burr. You can brag about it on social media. You can tell your friends. It's an awesome deal all around, right? You pat yourself on the back. You did good. The buy was smart. That's what I love about real estate, is you can't do that sort of arbitrage level in the public markets. It's just too hard to do. But you can do it privately. You can insider trade in real estate by finding off-market deals that are, or even on market sometimes, that are just, misadvertised, mismarketed, et cetera, and so forth. Sorry. And I think let's walk through that example. So if you had, say, $2,200 a month on a $200,000 property, you're like, wow, it's a 1% rule property. I put 50 grand to renovate it. It's just slightly under 1% rule, including my renovation budget. That's a slam dunk. I see lots of people slamming those deals around, and they're like, why would I ever not invest in real estate? Because look at how well I'm doing. And I'm like, you are doing well on the acquisition. You are doing well on the turnaround, on the flip or the burr. But as soon as that's done, and the property's worth in the 400,000 range, and in most cases you can never get, for some weird reason, you never get an appraisal for what it's worth. Like if the property will sell on MLS right now for 400, it always comes back appraised like 370. The bank's super conservative. They actually have written notes, and I've seen this from an appraiser that's a friend, from the bank saying, be conservative, stay in the low range. We're worried about overvaluation in Canada or in Southwestern Ontario. Please appraise in the low range. And so a lot of appraisers are just being conservative because if they go low, what happens? The bank's happy. The bank's paying them for the appraisal. They're happy because they're never gonna get sued. It's all around a win. If they go high on the appraisal, well, the bank will sue them if they have to foreclose and the value that they said the property is worth, they don't get it because the tenants, destroyed a unit a little bit or whatever. They would prefer to have the appraisals always be a little low. So that's typically what appraisers do to protect themselves. They would rather be conservative than overvalue a property because overvaluing means they could lose their license, means they could be sued. There's a lot of liability there, right? So most appraisers will be a little bit conservative. So let's just say you got this new revaluation. You're at $400,000 valuation on this $200,000 property, and it's very common that you bought. Your cap rate now is way lower because you're getting $2,200 a month in rent. You're probably barely cash flow positive, maybe a little bit of cash flow, but your return on equity, on the equity you have in the deal, even if you refinance, is not attractive. That's where I'm like, I talk to people, they're like, yeah, I bought that property all day at 200. I'm like, would you buy it at 425? They're like, no, that's a terrible deal. I'm like, you own it right now and it's worth 425. Why do you still hold it? And they're like, oh, because I'm a buy and hold investor. I bought a great deal. I'm happy with this deal. Don't want to sell. I'm like, right, but you just said you would never buy the property for what it's currently worth. Why are you holding it? So I don't know. It's a pet peeve of mine actually that most real estate investors don't do the math. And what's worse is that I do the math and I see that I have some of the properties that are like this, and I'm going to slowly dispose. I'm slowly listing properties that make sense. Again, there is the tax complication with it, and I can understand why people might want to hold to avoid the tax, but I don't know. Is a low return on investment, like most buy and holds here in London produce 7 to 15% levered return in most cases, net, if you have outsourced everything. That's not that attractive for the level of stress and risk, I think. I'll have a few properties, but I don't know. I'll probably always have a few properties just because I like to be diversified, and I think that there's some value in the control piece, but that's because I'm a control freak. I can see the merit in people have been trying to persuade me recently about REITs, and I'm like, it's a fair point. You can probably replicate most of the return that you could probably replicate most of the return you could get with a buy and hold portfolio using Interactive Brokers, leverage, and at 3-to-1, and then buying REITs that are also already levered. I like the weekly London market update. Thanks, Ken. Good timing. Michelle says housing market is slowing now and the condo market is still up, at least in Toronto. Interesting. Yeah, I think a lot of it is to do with the current lockdown rules that are forcing people in. No one wants to list. Like even I didn't want to list on MLS during this COVID crisis. I don't want to have people coming through my house, and I'm not even afraid of COVID. I may have even had it, but I think that it is scaring people. And I think that there's a fear of interest rates rising, which is coming and will reduce net returns. So I don't know. I don't know what the long-term market holds. I think if the government comes out with their stimulus package and they print some more money, then that'll drive real estate. So that's a catalyst. If they come out with UBI, that'll drive rents, which will drive real estate prices up. That's a catalyst for upward momentum in real estate. There are lots of catalysts that could drive the market further to new highs. I could easily see that, which is partly why I haven't sold everything yet, because I'm not sure we're at the top. And not that you can time the market, but I would love to sell when I believe we're at the top. And we're getting close to what I think is a top. But I think there'll be another, once we hit the top, I think we'll have a bit of a pullback, not a lot, probably mostly like a plateau, but we're gonna have no appreciation for a little while unless the government continues to print, which means we'll have no real appreciation. We'll have a fiat appreciation, but there'll be no real appreciation. Thoughts on long equity call options in the current market? Have future expected returns kind of pulled back to the point where people should be conservative and reduce risk? Yeah, I don't know. I think being with the long options, you could be wasting your money, right? We could be at a peak. I don't know. Anyone that says they know where the market is going, when it comes to the stock market, whether it's going to go up, down, or sideways, they're lying to you because none of us really know. Even looking at the technical analysis, You can tell a little bit, but like, again, no one has, where you could have like a full upward momentum. One piece of market news could come, or one institution could decide to sell and create a full downward trend, and you could break through every resistance level. So there's no guaranteed. If everyone knew there was a guaranteed like way to time the market, we'd all be like, I'd be a billionaire, right? I would just go hard leverage, and I would go all the way, and I would make huge money. But typically, what we know is that over a 5 or a 10-year span, the market moves upwards. So being super long on equities, I think you're going to be just fine. Short term, I don't know. We are at record highs given GDP and economic growth right now, and a lot of the job outlook numbers. I think that a lot of the growth stocks there's just a lot of optimism in the market. So am I heavy tech right now in my options trading portfolio? Yes, because the premiums are paying so well. Am I taking a ton of unnecessary risk? Yes. I probably should rebalance my options trading portfolio. I've been chasing premium as opposed to sticking to my fundamentals around solid quality companies that are not overvalued relative to earnings and future earnings. So I think that I should rebalance. That's a note to myself. I probably will do that. My portfolio is still up, like hugely up since my options trading experiment started in March. I'm up multiple 6 figures right now. So I'm making lots of money. I'm having fun with it, but it's a very small percentage of my entire portfolio. So I think reducing risk is always smart. And then if we see that there's a bit of a dip, that would be the time to potentially just start averaging in. Maybe average in all the way down, because you don't know where the bottom is, right? So as soon as you see dips, you just keep averaging in slowly as things dip. And then as things rise up, you slowly sell some, and then you keep all your profit for the top of the wave. That's kind of been my strategy. Don't sell everything, just slowly sell, and then you can kind of average. Okay, Ram says, I'm specifically thinking of turning around value plays like Kraft, Heinz, which have low reinvestment and the ability to pass on inflation easily. Yeah, it's a fair point. I could see someone looking into that. I don't follow them, but maybe I'll take a look and see if there's any value there. I agree. I think being focused on inflation resistant plays, or not resistant, but like, yeah, I guess inflation resistant is the word I would use, where you can pass a lot of that on and where inflation doesn't destroy their valuation, is smart right now. I think the governments are printing a lot of money, for sure. Next question. Do you have any money in crypto? Yes, I do. What is the best suggestion for a 16-year-old entrepreneur? Napoli, I think that it depends on what you enjoy. But if you're a 16-year-old entrepreneur, you can't even own stock yet. So I think that you can't own real estate until you're over 18 unless you have parents that will hold it in trust for you, or some adult that will hold it in trust for you. I think the best thing you can do right now at 16 is, if you're an entrepreneur and you've found something that you can exploit to make some good money, focus all on that. Like, go all out on that and get to a point where, I think that if you get to a point where you get your earning potential by the time you're 20 years old to, levels you wouldn't have been able to before, that'll pay off in like insane dividends. The other thing to do too is, beyond reinvesting in yourself right now and building your knowledge and not just your brand, but like your awareness, I think, around entrepreneurship, because there's a lot you don't know yet. At 16, there's probably a lot of things you don't know about business. So building out all of that awareness will pay out hugely later on. It's going to save you potentially millions of dollars throughout your life. And just remember that every dollar you can earn and save now versus, gaming or doing something that's non-productive, not that there isn't a place for that. Like, I think that there's a place for the R&R, the relaxation, and the, recharging before you go out and chase again and hunt. But I think that it's really, really important. Every dollar you can save and invest now will pay off dividends later. Like, if you can save $1 at 16, that's like saving, let's say you can save $1,000 at 16 right now. That's a lot like saving $10,000 or $20,000 when you're in your 30s. It takes a lot more money to save later than to save early, because the power of compound interest means your money doubles. In my world, money's been doubling every 4 years. Like, I double my money every 4 years pretty consistently. That's because I use real estate and I use a lot of leverage, and I go hard on the things that I'm passionate about where I can earn above average returns. Like, if I have a business that I know I can arbitrage and add value to, I go all in on that, right? That's just been one of my secrets to success. Now, I do take the profit off the table and I park it in safe, conservative investments where it could continue to compound and grow. I try not to spend it. That's the biggest thing. I'm getting older now. It's crazy, right? Like I'm 28 years old right now, and soon I'll be toward the end of this year I'm going to be 29, and so I'm running out of youth, and so a lot of my focus now has been what am I going to do to create a legacy and to into my 30s start building real family changing wealth. And so I think that when you're young, the focus should be on how to build those high income skills, how to start saving and building up a nest egg, start building up that gunpowder. Because if you have the gunpowder and you have the energy, which you do when you're young, then you could really amplify your entire financial journey versus waiting. A lot of people say, "Oh, go to college and just wait on that business idea and don't chase that and blah blah blah." I think those are all bad pieces of advice. There is some value, I think, in building core skills and those skills that are transferable, whether you go into a job, if entrepreneurship doesn't work out for you, or whatever. So there's a lot of value to that and to building up that money now. If you took $100,000 when you're 20, let's say, and you just left it and let it grow and invest, you'd have millions in retirement. You don't need to save another dollar. If you just worked hard from 16 to 20, you could be retired. Don't save anything else from 20 to 65. Not that I'm saying do that. Don't do that. Save as much as you possibly can and continue to grow and reinvest in that business. And if your business can produce, if you're like doing Amazon FBA or one of those high yielding businesses, you could reinvest and do 100% a year on your reinvested capital. Take that money and reinvest it back into your business. If you know you can invest $1,000 in marketing and produce $3,000 in income from that, every dollar you have should be going into marketing, assuming that it can scale well. Like a lot of people are like, "Hey man, should I be throwing it into like the stock market? I have $10,000, and I talk to them, and they're like an entrepreneur, like some sort of business, and like, "Hey, this is what I'm investing in marketing. Here's the return." I'm like, "Wait, you can put $1,000 in and make $3,000 back? Why are you not dumping all your money into that?" So chase the opportunities that are there. If you have a competitive advantage, exploit the hell out of that competitive advantage that you've developed, and further develop that and widen and broaden your horizons, of course, in business, because you may need to pivot, and having those broadened horizons can help you. But I think if you have a deep niche competitive advantage, you should definitely exploit that. What debt to equity in your margin account do you use? How do you manage the risk of significant drops like during the financial crisis? Chuck, to be honest, I'm not doing a great job at that. Don't look at me. I think that I'm taking more risk than I should. What I should do is use less margin. And I'm probably right now, I don't know, I think I've used almost, at certain points, as almost 2/3 of my entire available margin is used. So that's probably too much, to be honest. If I had to be assigned all of the contracts that I've written puts on, I'd be fully deployed and fully levered, or darn close. So that's obviously a big risk, right? But at the end of the day, you got to make sure you have the cash plus margin available to cover any naked put that you sell, that you write, right? That's important. And the same thing is true if you're selling calls, especially if they're naked. You need to make sure that, and I guess there is no, like, who knows how high the stock can go, right? At least with a put, you know what you're gonna get assigned at, right? Like, hey, I'm gonna assigned at 50 and my premium's $3, $47 a share. I'm owning this company, and you can plan for that, right? So it just depends. And you can strangle, you can build sort of like spreads so you can protect your downside. That's something I've been doing more of lately. If a position gets into the negative, instead of just closing it out, a lot of what I've been doing is just throwing in a call or a put, depending on what it is. But in a lot of cases, I've been selling calls. Like when a position gets to a point where I know I'm going to get assigned these shares, there's a very good likelihood it's like down 100%, or on its way down, I might sell a call at a price where with the extra premium, I'm almost like, this is a great price to own the share. I'm happy with it, and I sort of can make money as it falls. So on the up days, I'll maybe sell a call, and then on the down days, maybe I'll buy to close that sold call to make a bit of a premium. So I try to hedge in that way. I'm not perfect. I don't know. It's been going well for me now so far, but the market's been pretty hot since March. So yeah, I mean, days like today, at one point today, I was up 50 grand, and I think I closed negative 25,000 on the day. So I had a $75,000 swing today. I'm by no means perfect. I'm okay owning some of these tech plays, and I think there is value there. And as long as there's value in this stock and I don't mind owning it, I'm okay. So that's kind of how I rationalize it. Love to get your thoughts on interest rate rises, forecasts, and real estate bubble in Canada. Well, again, bubble, it's all relative. I think that relative to the amount of money they've printed, real estate has kind of kept on pace. In fact, in some of the Eastern Canadian and some of the even Western Canadian, like Manitoba and that kind of stuff, some of those areas, I think that the real estate there has actually underperformed relative to inflation. In fact, their dollar on their house can't even buy as much as it could before, just because how much money they've printed more recently, right? And relative to other places in southwestern Ontario. London, as an example, has kept up very well. We've done 45% appreciation in the last year. So I think we've outpaced inflation, which is fantastic, especially because I'm levered. And most people who own real estate are levered. And I think the only way you should own real estate is levered. But, what was I going to say? The other part of that question was interest rate rises. Yeah, that's coming. When the market recovers a bit, we're going to see a hike of at least 25 basis points, I think, in the next 12 months for sure. That will be that's rather a catalyst for a decline in real estate, if I'm being honest. But I don't see Canadian real estate like rapidly dropping. Canadians are very sticky on their prices. And if we can't sell the house for what we want, we just hold. Like a lot of Canadians won't sell their house for a loss. We saw in Vancouver as a great example of like Vancouver's a bubble market. We've seen people talk about like income to house price, affordability, all that crap to signal value. Look at Vancouver. Like literally no one can afford a house in Vancouver, and yet the price continues to rise. So you have to be in the market in Vancouver to actually pretty much own, for the most part, right? Like the market's just crazy there. A detached house is a couple $1 million, unless you're looking at like Surrey. But that was a little jab at Surrey. I'm sorry. If you live in Surrey, it's not that bad. I've been to Surrey, not that bad, twice now. I have a friend. Anyway, so I have a friend there, so I don't want to throw too much shade. But look at Vancouver, right? And we look at the markets like that are extremely, they've been a bubble for like a decade now, right? Like Vancouver's been insanely overpriced relative to the average person's income there. It's just a renter's nation, unless you are in the market and you rode the wave up. I think it's a possibility that London ends up like that too, where there's a lot of renters, and if you weren't already in the market, or you don't have parents that can help you get into the market, or you don't have a really high paying job, you just can't break into the market. And there's enough created wealth from all the people who rode the wave up that the people who made all the money on the properties they have, people like me and other investors who have made millions on the appreciation alone, we have equity to go and continue to buy so the prices don't fall. And so I think that there's, I don't know, Canadians are not, we're not like the Americans where we take on, we don't get into situations that would typically that allow us, or force us rather, into like a foreclosure. The foreclosure rate in Ontario is like, I think it's less than 1%. So you don't see a lot of foreclosures, and interest rates are still pretty low. And I don't think they'll ever creep up to a point where people will be defaulting like crazy. Like a 25 basis points is realistic. We'll see that for sure. 25 basis point increase does almost nothing for most Canadians. Like if you're on a fixed rate term for 5 years, it doesn't even affect you. If you're on variable, it's like $50 a month. You're gonna lose your house for $50 a month? No, like you're gonna pick up a shift at work and you're good. Or you're gonna like sell something on Facebook or Kijiji to make a mortgage payment before you default. People will be fine. They'll just tighten their belts a little bit. So I don't see a massive correction. I just don't see it. I see a plateauing like we saw in Toronto from 89 to 96. There was no appreciation. You bought a house in 89, is worth or about in 1990, you bought a house, and in 96, 97, it was worth the exact same amount. Even 90, 98, there was an 8-year period where like you had no appreciation. You bought a house, 8 years later, with the same amount, unless you renovated it. But then you just get your renovation money back. That will come again, I think, more likely than a big pullback or a big crash. So if you're buying for cash flow, which is hard to do in this market, I'll be honest. But if you are buying for cash flow, I can't see you going wrong. So that's my thought. But yeah, I think the rich are getting richer. So in the premium luxury market, we're going to continue to see big appreciations. The wealthy folks in the top half, they have a lot of assets. Like they own crypto, and they own real estate, and they own companies that'll rise as the government prints money. Whereas people on fixed income or people who are poor generally don't have assets. And so they don't tend to grow with the economy, they tend to just be stuck on their minimum wage, which is worth less than it was before, and that market suffers to the point where I can see a UBI becoming a thing in Canada. UBI means universal basic income. Very likely. I think it's coming. So the tax rates to follow will also come, which maybe means we should sell now the lower tax rates, sell real estate off. People like me who have huge tax bills could be bigger. Sony, good evening, hello. Ken says Twitter is down. Yeah, Twitter is down. I actually sold some puts on Twitter today. I also did that on Peloton today, Peloton. I also sold some puts on, what else did I sell puts on today? My brain's, I think it did a little bit of Mara and Riot. I'm trying to think what else. No, I sold calls today at the peak on those. Could you explain what interactive brokers means by maintenance margin? So Jamie, your maintenance margin is basically, someone else explain it down here, excess liquidity and buying power. So you can go look up the equations for it exactly. Basically, it's the amount you need to maintain. It's exactly as it sounds. And in buying power, again, same thing. It's how much buying power you have. I believe the calculation for it is I think the buying power is the 3.34 to 1. So whatever you have in your account times 3.34, unless, of course, you're already selling options, in which case it'll factor in it'll factor in part of the value to if you're being assigned. So your buying power, you'll notice will drop if the share price drops on your puts and they go into the negative. You'll start seeing your buying power drop. That's just because they're assuming you're going to assign those shares. Or same thing with if you sold calls, it'll start affecting your buying power in the same way. But yeah, excess liquidity is just how much liquidity you have available. You ideally want to leave some buying. Like you never want to be in a situation where you have less than, I think, 1 to 2 times at the maxed out 1 to 2 times the buying power of what you had deposited in your account. So you put 100,000 in your account, you should always have like around 100 to 200,000 worst case in buying power on the 100,000. I think when you first start, you'll put it in and you'll have like, I don't know what, like 400,000 in buying power when you first start on your 100,000, something like that. Because you'll have your own money and then you'll be able to go, or no, I guess it's 3.34 to 1. You can look at those equations though. It's a good question. I actually don't know the equation they use to calculate that excess liquidity. It would definitely be a calculation of market value on all of your securities, like your puts and your calls that you have. There must be some ratio they use to determine how much liquidity is set aside for a contract that you've written, like basically probably the probability that you'll be assigned. I actually don't know. It's a good question. I've watched it fluctuate as my stuff drops, and I know that as price drops on a put that I sold, I know there's a higher chance of me being assigned, so obviously my buying power is going to decrease because it's more likely I'll be assigned those shares. That makes sense. On the calls, the same thing. Like as the share price rises on calls that I've sold, I know it's a higher probability that I'm going to have to give them shares that I either own if it's covered or I don't own, and I have to go out in the market and buy them. I understand it's going to affect my liquidity, right? Yeah, so good question. I have to look up what those equations are, but I'm sure on Google you'd find that. What do you think of MindMed? I actually don't follow that at all. I don't know. I don't have an opinion one way or the other. I haven't looked into the company. Hey Mike, love this live that you do every Wednesday. You give a lot of value and I've been looking into the Tasty Trade platform for options. What is your look of sector rotation? What is my look of sector rotation? So you're talking about like different like seasons for different industries, like commodities as an example, or I'm not sure what you mean by that. But Tasty Trade is fantastic. I haven't actually done the course with Tasty Trade. I opened it up and I made an account and I watched the first 2 videos and then my kids came in screaming and so I never got back to it. I need to get back into it. There's a lot that I don't know and I need to know. So yeah, I mean, there's seasonality with several different sectors, and so you can, the problem is like none of these little rules of thumb hold true consistently. And so as an example, like, the whole sell in May and go away, or like you talk about, like with gold, how you talk about in the spring, there's a lot of weddings, so people tend to buy a lot of gold, and so gold tends to do better in the early spring. And then look at what India does with gold, because they're the largest consumers of gold. And so there are certain little trends like that, or like with building commodities and things like that, you can look at when most of the builds happen, so in the spring and summer, but like, I don't know. there are no hard and fast rules you can use that I would bet money on. That's more, it feels more like gambling to me, as opposed to looking at a company that has a solid financial track record, is producing cash flow, or is on a solid growth trajectory, and you can get that at a discount on a down day. That to me feels like a better play for value. So that's more how I'm less TA and trend trading. I'm more looking at the value in owning that stock long term. But I do gamble for premiums sometimes. So you'll see me buy stuff like you guys see me buying a lot of Mara and Riot, which are, and Can, which are, they produce the hardware you use to mine, like ASIC miners. And then Mara and Riot, they are miners. So they're mining cryptocurrency. I'm extremely bullish on crypto right now entirely. I think that while it is on fire and it has produced thousands of % return, and I wished I would have got in on it and like FOMO, but at the same time, I can see the use cases growing for it, and I can see there's a lot of value in having your money in the digital space that can't be, the thing I love most about it is that it can't be tracked by governments, and there's no currency. So when you could do business on the blockchain, and eventually it's going to be so efficient that there's very little currency cost, very little transaction cost. You don't have to worry about a bank stopping your transaction. Two people can conduct business from different countries in the same cryptocurrency. It's like a global currency, which is kind of cool. From an investment perspective, I can see the use cases. I love cryptocurrency that you can't produce. Like I don't like Dogecoin, the people's coin. I'm not about that. You can throw $50 in it, whatever, YOLO. But like, I don't actually see it as a real, like, I don't see a lot of use cases for Dogecoin. It's like it just attracts speculators. So that I'm not attracted to. But like Ethereum, as an example, a lot of the altcoin projects right now are built on the Ethereum platform. It has a lot of good use cases. I think it's undervalued. I'm currently mining it. I'm currently doing transactions, right, for people. And so I think that there's, I think there is value in that. And I think that I don't know. Price point, I don't know. I hear analysts throw, depends how much of a bull you are when it comes to crypto, but some crazy price appreciation. So I'll throw a little bit in. Why not? And you should buy Hut 8 instead of Mara, right? Maybe I'll consider that actually. They were one of the biggest in this space, especially Riot. I like that they've been acquiring a lot of companies. They're pretty big. And so I just want to be part of it. And I'm like, hey, let me find some companies that would allow me to be part of this crypto revolution. And so that's what I did. I'm also acquiring some of the ETFs that mimic Bitcoin and Ethereum just because it's easier and there's less transaction fees associated with it. There are a lot of transaction fees, and it's a pain in the ass to set up an exchange account, wire your money there, or use your credit card to buy stuff. And then it's just a lot of exchange fees, and it's just a headache. But it's really easy to buy like an ETF that mimics it. So I don't know. That's just been me. I'm just lazy. Like just the amount of work to set up the account and then get money wired there. I gotta get around to it. Buy some. I have a little bit of Ethereum and some Ultra and some Kudos and some other stuff, but it's minor. Minor in the grand scheme of my net worth, right? If I put even like 1% of my entire portfolio of assets into crypto, that would be huge. That would be like, most people would be like, whoa, you're putting that much in crypto? So for me, it's a very, very small percentage of my portfolio. I would like to get to a point of having like 1% to 2% in cryptocurrency in case it goes to the moon, in case a lot of the people who make really good valid arguments for why we're moving away from a fiat US dollar-based system to a digital cryptocurrency system, in case they're right. And I think they might be. It seems like in the long term, we'd all want to switch over to using crypto, if we could find like a stable crypto, as opposed to using a fiat system where they can print as much as they want of it. And the beautiful thing is, how do they tax? Like, how are they going to tax it? Good luck. If it's on an offline wallet, you can't track it. If it's created in mine, you can't track it. It doesn't exist. They say, hey, give us this. You say no. How are they going to get it? They can't. You can transfer it to anyone in the world anytime you want. At a bank, they can freeze your account. They can steal your money and Sarah gets their money. They can't do that on the blockchain. So it's really like a freedom thing in a lot of ways. I like that. Or even people doing like a lot of good use cases where you could use it to exchange like games. Like you buy games or buy art or buy whatever, using NFTs or whatever. You can buy and trade games, as an example. Ultra is a good coin. And like as a gamer, I can appreciate that. Where on Steam, you can't sell your game. I think with the Ultra coin, you can do that. That if you check out that project, UOS is the coin ticker. But it's just, I think that's an example of a great project that if they could steal some of Steam's market share, that would be huge, right? I can see that on the blockchain, having games that you can play and developers building it on the blockchain and then being able to transfer those games to other people, that's cool. Whereas now you got to physically trade a disc, or you're stuck on Steam where you can buy the game and that's it. You can't give it to your friend. Whereas now you're gonna be able to do that. You can sell it for Ultra, right? So there's a lot of use cases for blockchain. I've liked blockchain technology for a long time. I just didn't see a lot of good projects where I could get behind it. And now I do see those. So where I was bearish in 2017, I'm now bullish. And that's because a lot of things that I didn't think could happen in the space around technology and around user adoption and use cases, it happened. And so I'm like, okay, it's here faster than I thought it was going to be. I like the blockchain technology. I always have. In 2012, I was looking at Bitcoin with my uncle. And I'm like, okay, I can see this, but we're way too early. And I didn't see a use case. I didn't see a lot of use cases then. That was the time to buy. But again, like that's the same for anything. Like who would have saw that Tesla would be the #1 EV, car company, and that EV vehicles will be half of all vehicles driven. Won't be gasoline by 2040 or something. It's like they're all going to be. We're moving towards an EV trend, and anyone had the foresight to see that trend and buy that before, they made a lot of money, right? Okay. Next question. What do you think of high dividend covered call ETFs? I think that it can make a lot of sense where you lose when the hedge funds or the ETFs are doing a covered call type approach is if there's a big growth spike, you lose a lot of that growth, right? The other thing too is some of them settle daily. And so the fluctuations can kill your overall return. I feel better about a levered dividend growth portfolio, but the problem is doing it at scale with the calls, right? Yeah, it can make sense. Some of them are solid. I don't know. I haven't really followed a ton of them, but yeah, in theory, at scale, it's more difficult. In practice, it's more difficult. In theory, yes. In practice, more difficult to realize the same sorts of gains. More printed fiat equals higher markets. Yes, that's true. What would you say is the biggest weakness in your covered call method? The biggest weakness would be the risk of a margin call, would be the amount of time that it takes to do it, would be that you can't, so in the wheel strategy that I talk about, the biggest risks would be that you lose out on a lot of growth in selling the puts. So you sell a put on a company that's awesome and it goes up 10%, and you don't make that much because you didn't get assigned the share, you didn't own the shares, you just got a little bit of premium on that company. So you lost a lot of that growth versus just owning the shares. So that's obviously a risk on portfolio return drag. Another risk is when you're buying the puts using the covered call premium, that they're too expensive, or you have to buy them really far out of the money to make them worthwhile, in which case you're not that protected against a small pullback, which could kind of crush your returns. I think that it's one of those things where the covered calls too, you could give up a lot of your growth potentially as well. So that's something that you got to kind of look out for. If you set the covered calls at like maybe 15 or 20% appreciation from the current share price, you don't get that much in premium. So you have to set it close enough that it makes sense. You're getting enough of premium to be worth giving away your shares. So yeah. I think I just saw a super chat come up, but I don't see the super chat. Oh, wait, it popped up. Watts sent a $20 super chat. Thank you, Watts. So Watts gets premium because he asked the question with a super chat. Watts says, hey Mike, do you know if a lender can pull a credit report on my corp? Is there such thing, or can they only pull credit on my personal name? So Watts, your corp does and can have a credit report attached to it. However, if your corp doesn't have one, doesn't have established credit, they'll often pull your personal report and look at that instead. Now, pulling your personal report is like a soft inquiry. It's like inquiry. and that would cost you like 3 points. It's not much. That said, if you have a stable corp that's been around for a couple of years, making credit card payments, making loan payments or whatever, and you've got maybe a cell phone or internet you're paying for in your corp, then your corp will develop a credit score on its own and can qualify on its own in theory. Most banks will still want a personal guarantee, and they'll still want to check your personal credit as part of that check on your personal borrowing capabilities. So most of the time, they will look at your personal credit score. It's not as important if you have an established corp with a couple of years of financials and you have shown some ability to make payments in your corp. Hopefully that helps. I think I'm right here at Chuck's. Why do you gamble with options instead of buying the index and holding on a 1.3 times margin? It's a great question. One reason is active traders inside of a corp are subject to 12.4% tax. The second reason is it's fun. I enjoy it. So those are the two reasons why I don't just buy the index and let it ride. The index, you're going to be subject to the capital gains tax, which would be, 54% in a corp. Now, when you pull it out, you'll then have a capital gains reserve that'll allow you to basically go down to a 25% tax rate personally by pulling it out. So in theory you could. The hope is that in collecting all these premiums, and if I'm smart about it, staying far enough out of the money that don't get assigned, I get money for nothing, and I end up owning the shares that I want to own anyway and building my own portfolio that can, in theory, produce better than the index. But we'll see. I don't know. I know people over the last 10 years have been options trading and have beat the market every single year for 10 years. Now, we've been in a bull market, and there's been a lot of volatility and a lot of factors working for options traders. But over a 25 or 30 year period, you shouldn't be able to. What I'm hoping, though, this is sort of my theory, is we have a lot more DIY traders in the market. A lot of people are getting in and just trading options or playing around in their Robinhood accounts and whatever. And we've never had this before, this widespread accessibility by the masses. And that has big ramifications. Things like Dogecoin or like GameStop or all those companies got blown up that shouldn't have been. Like GameStop's overvalued, Dogecoin overvalued. Speculators pump something, everyone jumps in and buys it, and these people have no investor knowledge at all. You've got people with like just retards with like a 95 IQ jumping in, like throwing 5 bands on GameStop because they read it on Reddit and everyone else is doing it. There's memes about it. That's crazy. That like the value of a company or the value of whatever you're speculating on can be driven by social media memes. That to me is like that's a new paradigm. So I think that and options are complex, but I think that more and more average people are starting to trade in the options market, are starting to trade stocks. And so we're seeing more volatility. And I think it's possible that longer term, investors who are smart and make money off the volatility can outperform the index. And that's because there's a bunch of dumb, stupid money floating around in the market, pumping and jumping and dipping the market in ways that didn't before. Before the market was efficient. It's way less efficient now than it's ever been because there's so much less institutional money and so much more DIY money that has no fundamental understanding of anything. Like literally like the tulip situation on every company that gets pumped. And it's crazy. It's wild. You don't want to bet against the people because you could lose a lot of money. But at the same time, you don't want to invest with them because again, they're investing based on nothing. Like, hey, that looks cool. Let's buy it. He's buying it. I'm gonna buy it too. Cool. That's the whole ethos or theory behind a lot of these pump and dump schemes, right? Or not even pump and dump, but like these investment plans people are making. And I don't think they're really making a proper plan. I think they're just like, hey, everyone's talking about Dogecoin. I'm gonna get some. Everyone's talking about GameStop and FOMO, fear of missing out. They jump in and just buy some for no reason at all. Even I've been subject to some of that just because friends are getting in. I'm like, fuck it, screw it. I'll just jump in and I'll, like I did a little bit of spread trading on GameStop just for fun, right? Like with limits set because I don't actually want to own the shares in GameStop as an example. Now, with all that popularity and all that capital, could GameStop turn into something that's a profitable, viable company? Maybe, yeah. Could Dogecoin, with all the people's support, become a viable cryptocurrency? It was a joke. It was literally a meme coin joke, but it could become something with enough user adoption. That's what matters, is the people. So it's kind of crazy, the new world that we're in. So I think long term, that has big ramifications for potentially outperforming the index. This is what I mean. What is your look on that? I don't know what that means, that question. That must have been for a different question before. Ruben says, what are your thoughts on Chatham and Sarnia housing market? Chatham sucks. Sarnia also is pretty, not that Sarnia sucks, but like it's really tied to the Chemical Valley, and it's very much a trades town and a retirement town. There's not a lot of growth in Sarnia. It's also close to the plants, and so the air quality is terrible. Like 60% of people born in Sarnia are female. The biology is messed up there. The water, the air. I grew up in Sarnia, so I'm talking facts here. It's a rough culture in Sarnia. So do I want to live in Sarnia? No, no interest. I grew up there. I know it's terrible. I couldn't wait to get away. But am I investing there? Yeah, I think cap rates do make sense. I think there are still value plays in Sarnia and Chatham. There is more risk. The real estate is not as safe as in a larger metropolitan, but can you flip and make money there? Hell yeah. Am I doing it? Yeah, I am right now. Not in the MLS, like I'm not looking at anything on the MLS. I have no interest in the MLS really. That's not true. There's a couple deals that pop up on MLS, but a lot of work. Okay, next question. What percentage of your total debt do you have available in lines of credits? I don't know. Not very much. Well, I'm mostly deployed. I like to keep my money working for me at all times. I have a little bit. Hey, Mike, what's your advice for claiming income if in the top 53% tax bracket? What would you prefer to keep most in the corp unless you actually need it? So my advice for claiming income, well, you have to claim all the income. You can't not claim income. That's fraud. But what I prefer to keep in the corp, I would say capital gains make more sense in your personal name in most cases. It's slightly better tax treatment. Anything active, any active income plays a huge part in, anything active you can get at up to $500,000 per corp. So you don't put your spouse on it. You each have your own corps, and you can each get up to $500,000 small business deduction, which takes you from like a 25% tax rate down to 12 or something, is my understanding. And so again, talk to your own accountant, your own legal advice, and your own tax advice. But my understanding would be anything you can create into active income, like active trading, day trading, or investing that's active. Anything related to an active business, any flips, you definitely want to have all that inside of a corp. Whereas even crypto mining, that kind of stuff, all those active businesses inside of a corp. In your personal name, you'd want to have, again, if you have kids, as little income as you can in your personal name. Put everything into corps, because you can collect that Canada Child benefit, right? If you can shelter everything inside of a corp and just take out exactly what you need to live. The bare minimum would be, one prudent strategy given the huge clawbacks that exist around the Canada Child benefit program. Every dollar that you make over $32,000 is a 19.5% clawback. Is effectively a 19.5% tax that you lose if you have kids. So if you have kids right now and if you make anything over $31,000 as a couple, together, each dollar is 19% clawback. Once you get over $70,000 in income, it's a 9% clawback. Once you get over combined family income of $220,000, the Canada Child benefit disappears. So it's a non-issue at that point. But yeah, it really depends on where you're at. You have to run your numbers, but it's crazy. The middle class, they should not be making money in their personal name. It just doesn't make sense. Try to move as much as you can into corps, into the TFSAs and the investment sheltered vehicles. Did you retire on 1 million? I was a millionaire when I retired at 24. Yes, I will say that. Watts, thanks again for the super chat. Really appreciate that. That's awesome. Hey, Mike, haven't been on here for a while because of moving and personal situation. Will be tuning in weekly from now on. Love all your content. Thanks, Will. Good to see you on. And Chris says, hey, Mike, do you ever use leaps as an options trading strategy? So the idea of leaps is you'd buy a call that's like a year out on a said stock position that you like, and for a small premium, you now get all of the upside if it goes above the said strike price. So that's what a leap call is. Do I use leaps? Not really, but I can see their value. If you're really bullish on a stock, instead of owning the stock, you could control any of the profit on those said shares. Each contract's 100 shares, right? So you control a lot of potential shares for very little money down, which essentially allows you to gain all of that upside appreciation. And if you're wrong, all you lose is the value of the contract that it cost when you bought that leap call. So leap calls are a fantastic way to limit downside and potentially enjoy all that upside. The risk is it doesn't hit that target. It stays within a band throughout the year or goes down and you lost all that premium. So that's you just lose that money on buying that contract. The hope is that you're buying something that you believe in the short term will go way up. Is it possible these days to find deals for any real estate investment strategy? Seems like everything is through the roof. Well, a deal is relative, right? So at current prices, there are deals at 70 cents on the dollar. However, 70 cents on the dollar today is like pricing 8 months ago. So if you bought something 8 months ago, it's the same as buying now for a 30% discount. That's how crazy the market is. So it's all relative, right? When comps are going out the window, when there's such crazy appreciation that, yeah, it feels like there's no deals, but relative to the price of things, currently you can still buy below market. And so there are deals that exist. It's just relative to the market comparables. Hey, Diao2, good to see you on. Ruben says, thanks for replying to all the IG messages and providing good content. No problem. I try my best. It's a big time commitment. I do dedicate a lot of time to Instagram. I'm sorry if I don't respond to everyone. I just can't. Some people want me to they give me their whole life story and they literally want me to coach them. And I'm like, it's this, send that to me. It'd be better if you just sent me an invoice for $100 and was like, can you just give me $100, Mike? No, I can't give everyone $100. It's not enough for me to go around. I don't give so much charity. So, and then the worst is when people jump in and they'll send you a big message and then they're like, screw you, man. Like, I hate you. I can't believe you didn't respond to me and give me detailed advice. Or like, wow, a 1-sentence answer? I can't believe you. I'm like, what? That's like coming up to me and asking for $100 on my wallet. And then when I give you $10, you're like, what the hell? Why don't you give me $100 for free, man? What's going on here? It's crazy. Some people's entitlement is the word. But thank you so much for watching, everyone. I really appreciate everyone that tuned in for the 62 minutes that stayed for the stream. I know today's title was not catchy at all. It was just what I was feeling today with all of the plethora of opportunities that exist around me. I am stressed with analysis paralysis, trying to analyze all the different opportunities. There's only so much time in the day, and I find the more money you have, the more businesses you're involved in, the more stress associated with that. So sometimes more money, more problems. I think that tonight's stream was a good one. It ended up turning out pretty good. So thank you all so much for making the stream good. It's your guys' questions that drive the chat. And thank you so much for watching. Smash that like button if you're still here watching. And if you're watching the replay, jump in the comments. Say hi. Hey, Mike, just watched the video. Thanks. Or, smash the like button. It's a little blue button right there. Thumbs up. Just tap it for me. If you got any value from this, there's a segment that you really liked, say that in the comments. Be like, hey, at 42 minutes to 45 minutes, love that piece about X or Y. It allows someone to find that comment and then hopefully watch that part of the video and extract some bit of value without having to watch the whole over the hour stream, because an hour is a lot of time. Thank you so much, everyone, for watching. I'll see you on my Instagram channel at Mike Rosehart. And as you guys know, the secret to unlocking a wealthier you, 3 levers. Spend less, earn more, and maximize return on the difference. Spend less, earn more, and maximize returns, everyone. Have a good Wednesday, and I'll see you next week, and I'll see you on the comments and in Instagram.